Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Chief Investment Officer.
Matt Mondu, Senior Financial Advisor.
And Dan Cedar, Managing Partner.
So we've got plenty to unpack today. What I would say is we will predominantly focus the conversation on year-to-date performance, some observations that we have. That includes both domestic and international observations before we segue a little bit towards other asset classes like crypto, as well as taking a step back and understanding the macro perspective that's coming down the pipeline. So without further ado, I think it's very fair to say that it's been a volatile experience year to date. And you wouldn't necessarily glean that from just looking at headline market returns. I would say that right now the biggest headline is that you've got U.S. equity markets that have staged a very strong rebound, culminating with the Dow Jones Industrial Average closing above 50,000 for the first time ever. And this is as of this recording on February 9th, end of week, February 6th. So after a pretty volatile stretch in January that included a sharp sell-off around January 20th due to tariff fears, you had stocks that have really bounced back decisively in early February. For example, the Dow jumped more than 1,200 points on Friday, February 6th, leading major indexes higher. Tech stocks have helped lead that recovery, with companies like NVIDIA and Broadcom posting strong gains as chip and artificial intelligence spending optimism has returned. And despite this milestone, the rally has been somewhat uneven. The S&P 500, which is a cap-weighted index, as we've talked about, still shows pretty choppy performance, and the NASDAQ tech-heavy index lags behind, indicating that this rotation into cyclicals and value names has very much been alive and well. So before I kind of open up the conversation, what I would say is that breaking 50,000 for the Dow is a psychological milestone and may attract more tactical buying. However, the underlying breadth and sector divergence suggest some caution. What do you guys make of this? And I guess specifically within the context of some of the themes we've touched on already this year, how does this make you guys feel?
Well, I'll start. I think it's nice to see the markets being led higher by stocks other than the Magnificent Seven. I think that's been the theme really for the past, 23, 24, 25, 23, 24, 25. And it's nice to see 2026 start with some other businesses. When you look at the Dow, the top 5 holdings are Goldman Sachs at 11%, 12%, Caterpillar just over 8%, Microsoft just over 5%, Home Depot just under 5%, and Sherwin-Williams just under 5%. So you have a lot of different types of businesses leading the Dow higher than the types of businesses that will ultimately lead the S&P and the NASDAQ higher.
So I agree with that, Matt. I do think it's nice to see a different set of names, but I think it's important to remember the construction of these indices is flawed. And even if you're looking at the Dow now versus the S&P, where the S&P is a market cap weighted index, the Dow Jones price weighted. Yes, great to see the Dow Jones go above 50,000. It is the people's index. That's what people talk about. No one ever talks about moves in the S&P 500. They say the Dow was up 1,200 points. I think the real flex here is the equal weight S&P 500 going out at all-time highs.
Yeah.
The equal weight S&P 500 all-time highs. That's the flex. It's not. So I don't want to get wrapped up in the Dow. I think it is important, but you're seeing participation across the board.
Yeah, well, which is important, right? We've talked about this at length over the last few years. A good measure of the market is not necessarily a cap-weighted index that has 35% of its exposure in 5 names, right?
Bingo.
So if you want to get a reliable gauge on market health and market optimism, seeing the S&P 500 equal-weighted index up north of 5% this year versus the S&P cap-weighted that was actually negative at one point last week, to me, I can be very optimistic about that because it is a sign of greater breadth, greater fundamental momentum in a larger set of businesses. And that doesn't even begin to talk about some of the smaller businesses and how we've seen them progress this year, or international markets. We've seen the momentum continue there as well. I think all of this is ultimately signs of a very healthy market. And it's also very grounded in fundamental developments, right? I mean, we talked about international, for example, right, Matt?
Yeah, I mean, international, that's been nice to see as well. 2025 international outperformed U.S. markets. That trend's, going to continue. A lot of reasons for it. I think fundamentally based, but also some of the things going on in their, political central bank landscape as well.
Yeah, I mean, and I think that, again, we've talked about the dollar in the past as a driver of international markets, but keep in mind, international is this very easy way to talk about many, many different countries that have many different fiscal and monetary policies affecting them. But when you see an environment for international markets from a monetary policy perspective that is generally supportive, you could say the same about the fiscal backdrop in international markets, generally very supportive, which is why you're starting to see money flow towards those international markets, and not necessarily at the expense of U.S. exposure, but there are very friendly policies that have emerged and have pushed the dollar lower and have been good for international markets. And again, if you want to talk about the technical perspective, that kind of adds up too.
And that's the thing, international markets have been cheap for a long time. Cheap on an absolute level and very cheap relative to U.S. markets, but they've needed a catalyst. And we might finally be in a situation where they're having a catalyst. And, we often comment when international outperforms, it usually does it for a longer period of time. It could be multi-years. So we could just be in the first innings of international markets starting to outperform U.S.
Yep. I agree with that. How about domestically? What about large versus small?
Yeah. And, the theme that has emerged, we're seeing the Russell 2000 index, which is probably the most common measure of small cap stocks, up 8.5% year to date. And that is, obviously outperforming large cap. So, you can think of this in a couple different ways. Number one, the interest rate backdrop will generally be a larger driver of smaller businesses when compared to large businesses. But I don't think that that's my main takeaway right now.
Real quick, let's break that down. So what you're saying is if forward-looking if interest rates in the future are projected to go down, if we're seeing a declining interest rate environment, you would expect, all else equal, small cap outperforms large cap?
I would. And if you look back through historical periods of monetary policy that includes declining interest rates, the 3 full interest rate cutting cycles that we've had between 2000 and today, all 3 of those cycles did show small cap outperformance relative to large cap.
And is one of the main drivers to that? I'm sure there's others, but it's just harder for small businesses to get capital. And so if they're out there borrowing money and you're borrowing money at high rates versus low rates, the larger companies can absorb higher rates more effectively.
I think that's a very easy way to think about it. The interest burden for a small business proportionately to a large business is just much higher.
Yeah.
Right. So if you get that easing and becoming less of a factor, you start to expand the multiple for a smaller business. So long story short, I would agree with you, Matt. I think there are legs for that international story to continue. I think there are a reasonable amount of legs for that small cap story to continue. But, to kind of close out the market returns portion of this discussion, I think the question that everyone continues to ask is, well, within the U.S., what do we do with this artificial intelligence trade? And I don't think there's a very easy answer to that. But because of how quickly the technological developments are coming down the pipeline, I think you're going to start to see a diversified set of winners and losers. Most recently, you've seen a lot of the software players take it on the chin in the market because of fears around disrupted business models and less enterprise usage of some of this software. At the same time, what's continued to be a leader in the market is the backbone of artificial intelligence, the power generation story. I guess long story short, I don't know if 2026 ends up being a year where the usual suspects reap the biggest benefits, both from a financial perspective and a market return perspective. I think you're going to start to see a more clear delineation of winners and losers as it pertains to this artificial intelligence story. And it may not just be your usual suspects in the Magnificent Seven. So again, we don't have all the cards to be able to tell the full story right now, but that's just an observation that I have from the early innings of 2026.
And if it's priced to perfection, there's plenty of opportunities outside of those big names, the Mag 7 names. So go elsewhere. There's other opportunities. Take advantage of them. You don't have to continue to pursue or chase opportunities that are priced for perfection.
Yeah, that's exactly right. And the market's focused on those underpriced names, at least thus far this year as well. Maybe one other asset class that we can kind of shift our conversation towards is crypto. I mean, crypto markets have remained incredibly volatile. Bitcoin and other altcoins have been under pressure. I think this has been a pretty dramatic story so far this year. Deep drawdowns, intense volatility, and ultimately just debate on whether the worst is over. So what has actually happened? Well, you've had Bitcoin tumble from multi-month highs and at times dipped below 60,000, which has wiped out a large chunk of its gains since late 2025. Other coins like Ethereum and Ripple also declined. So I think what you're seeing right now is broad risk asset selling. Potentially some of this is coming from leverage liquidations and ETF outflows. You did see a bit of a rebound last week with Bitcoin consolidating above 70,000, but to me the confidence just remains very fragile right now. So I'm not really sure that I want to make more out of this than we need to, but part of the reason that Bitcoin and other cryptocurrencies from a retail investor perspective have been attractive are not just because of the return potential, but because of some gleaned diversification benefits. Whether or not that actually exists, I think we're still too early to the cryptocurrency story to be able to say definitively. But, again, we are not investors in these cryptocurrencies at scale. I think it's really hard for us to get comfortable around something that is near impossible to value. I mean, I always talk about it like a piece of art or a bottle of wine. What is it worth? Well, it's worth whatever anyone's willing to pay for it, right? Mm-hmm. How am I supposed to get comfortable with valuing an asset like that? It's really hard to. There's no cash flows. There's no real fundamental backdrop for it.
Well, this is super opaque, right? There's an element of you buy a piece of art or something, you kind of know who you're buying it from, who's owned it, what did it go for in the past potentially, and this is totally different. I mean, so these things are going to happen. Crypto got a lot of attention really early. In the grand scheme of financial assets, this has not been around long. Well, these things will happen.
It's going to take time for institutional adoption to really gain steam. It's happening. It is happening. But still, while I guess we could say this is a reflection of the risk appetite in the market. Is that true? Yes, I do think that cryptocurrencies are a reflection of risk. If risk is running rampant, then these asset classes will probably go up. But I also think there are times for technical sell-offs. It's a very technical asset class. Daniel, to your point, there's not earnings. Okay, so we can't run a PE, price to earnings analysis to understand is Bitcoin over or undervalued. A lot of times it's a technical trade, and what you see is when enough people start running for the door, everybody follows, right? It's momentum. So I think you saw some momentum to the downside. Where does it go from here? Who knows? I mean, it's not like we can guess up or down, but I think it's very much a technical trade.
Yeah, definitely agree with that. And maybe just to close out, some things that the market is focused on or where the market focus is shifting towards, I think that as we wrap up earnings for the fourth quarter, at least in the U.S. here, market is starting to shift towards macro data and yield signals. So looking ahead, I think that upcoming U.S. macroeconomic data, especially that which pertains to jobs, the labor market in general, inflation, anything that could steer the Federal Reserve and ultimately risk assets, I think those are going to be increasingly important in terms of shaping the market direction. So the jobs data that's going to come out later this week, as well as the consumer price index, I think these are going to continue to be major catalysts. Strong figures out of these could end up keeping Federal Reserve policy tight, whereas we're starting to have the market price some interest rate decreases in the coming months. If you did get softer readings here, it could end up being a scenario where bad news is good news because people start to think that the Fed's going to cut more than they originally expected. But I think by and large, these themes that we've seen develop in the equity market this year, cyclical stocks versus tech, growth versus value, this rotation trade, if you were to get continued developments economically that support this trade, I think there is plenty of room to run. And keep in mind, when we talk about the S&P 500 equal weighted index outperforming, a lot of that is supported by companies that are undervalued being bid up and having their valuation catch up to some of these higher growth type names. So if you do get the backdrop economically, that is one of, call it, softer job growth, moderate inflation, I think that trade does end up continuing. And the closing point here is just that economic data is no longer background noise. It's the main event right now. And I think that does continue to be the case as we progress through 2026.
Anything else?
That's all I got for now.
We covered it all.
It's a wrap.
Okay. Well, as always, thank you so much for tuning in to another episode of Blue Chip Now. We look forward to speaking with you again soon.